Good afternoon. Welcome into Market Talk for this Thursday, February 17th. Great to have you join us once again. Thanks for making us part of your day. I'm your host, Jesse Allen. Find us online, markettalkag.com. That is our home on the web, markettalkag.com. It's where you can find all of our streaming sources, our social media links, the latest news of agriculture, much more. It's all online, markettalkag.com. Well, we had another volatile day in the markets as we continue to watch the geopolitical worries with Russia, Ukraine, and much more. Here to dive into the market trade on this Thursday with us, our good friend Bryan Doherty with Total Farm Marketing joining us here this afternoon. Bryan, good afternoon to you, sir. And man, started out, looked like it's going to be a strong day for the soy complex and corn and wheat. And then we kind of faded in beans and corn held firm and wheat was our leader today, but just a lot of volatility. And I think a lot of it centered around this Russia Ukraine situation.
Yeah, right on. I think that's kind of top news and top of mind right now. And then you can probably shift to South America and then elsewhere. Um, a lot of rumors today. In fact, I'm not even sure how far I am up on the news, but there was some talk of some mortar fire between two sides this morning, and one blaming the other. I don't know if that's true or not, but suffice it to say, the wheat market kind of grabbed the bull by the horns today and moved up pretty swiftly, and where there's a little bit of smoke, there's probably some fire. So I think there's more stress in that sector of the world. Probably the market that finished okay is soybeans 4 to 5 higher, but really had some strength early on. Some really good export sales, both on the daily announced over I don't remember to whom, unknown destinations. I should say I
Mhm.
don't remember, 121,000 tons, something like that. Again, it was just another sign, though, that the void from the southern hemisphere crop that's under weather stress is being filled in the U.S. And then our weekly sales were just great, 50 million bushels on the weekly export sales number for the 21-22 season. So that's I'm going to say stuff or beans in storage, and then 56 million for next year. That's impressive. So that's on the crop we're going to grow. So again, some preemptive buying on a what we call inverted market, where the old crop this year's production is higher priced than what next year's will be. So looks like the end users taking some action.
Well, and to your point, that daily announcement was 120, just shy of 121 today. And then the weekly side, a good chunk of those sales was to China or unknown. So, to your point, really kind of shows that South American void, that worry there. China stepping back in to buy soybeans here from the US. And I have to think, we'll call medium term the next couple of weeks ahead, months ahead, that's going to be very supportive to this soybean market, Bryan.
Right. So where's a fair price for beans? What's the equilibrium price? When I had economics in college, it's where quantity of supply meets quantity demand on a chart and they cross over, right? But
Mhm.
that's always in movement and in flux. So your lines are moving. What is the demand? What is the supply? So those are the real numbers that are in flux right now. The demand we know is really solid, mostly because of smaller supply out of South America, and that's still unknown at this point. Another generally dry and hot forecast for the same regions. So you can only knock that crop down so much, but it's still being knocked down. And so support there. Problems in parts of the north. A lot of media coverage of some significant flooding in I can't remember the town in Brazil, in the kind of the eastern near the shoreline, north of Rio Grande do Sul, um, and concern there about getting crop in timely and quality, and then trying to get that second crop corn. So a lot of dynamics. That's probably the second big story, is just the weather in South America. Stock market down over 500 today. Boy, kind of the norm all of a sudden lately for 500 lower, three or four, 500 higher, but kind of a rough day. Which again, I would think that's a little bit more concerning for the entire um, geopolitical scene. I think the
Mhm.
market's reflecting that. Lastly, something we haven't talked about here, but it's been kind of creeping up and creeping up and creeping up, is really the currency fluctuation. The Brazilian real has been trending higher since early January. And it's about 10-15% higher in value. So in theory, that makes US beans more competitive, or are competitive on the world market.
Well, we look as well, not too far off on the horizon is going to be the US planting window, a few more weeks ahead. I mean, we look at where these prices stand, beans, corn, wheat, spring wheat, cotton, all these different commodities that we're going to be planting here presumably in the next few weeks. One has to wonder, what's going to happen with this acreage battle, Brian. I mean, we keep running soybeans up in price. I mean, what's the point where we start to ration demand? I mean, what's the point where, things change? I mean, I'm very curious how this acreage battle is going to shape up here as we get into the spring months in the US.
Yeah, we all are because when you, sometimes you get a supply shock in the corn market or beans, it's usually both in time. They just go straight higher. It's something in weather, right? But you don't see like, let's say, livestock prices move much. Well, cattle are into new contract highs here just this last week. Dairy prices new highs, hog prices screeching into new highs. So the backside of these higher grain prices is higher product prices for other commodities. Is it enough, or does it just keep everything kind of greased and moving forward? So it's kind of this inflationary idea. You just got to keep buying because everything else is moving up. And it really seems like that's where the money flow is right now. It's on the long side of most everything agriculture. The commitment of traders reports will indicate that, and they continue to show week in and week out that funds are either 350 or close to 400,000 net long contracts of corn. That's a lot of corn to be long at these high prices. So it's indicative of a sign or belief that prices are moving higher. Globally, long term, I mean, things to watch out for. There was an article this week regarding China trying to cut back on 30 million metric tons of soybean using substitutes for soy meal, less soy meal, some sort of um, proteins added in, things like that. That what high prices do is they get creative activities in place, so watch out for things like that. The other thing, just watch out for China's economy. Really not in very good shape. The concern there is if it continues to decline, purchasing power just isn't as strong, and we might find that agriculture products end up suffering from that. So no sign of capitulation today by the Chinese, but certainly something to kind of keep in mind more on a global perspective. And the reason I bring all that up is not to confuse your listeners, but to recognize that we're at really high prices historically. The trend is up, but we need to be defending or making some small incremental sales into this.
And that is just where I was going to ask you, Brian, as a farmer, what should I be doing right now? And you answered my question for me, defending and maybe making some sales into this because you are right. I mean, these prices are at levels that I just can't imagine that there's not profitability out there for farmers on various operations.
Well, inputs have certainly screamed higher, and so that's what farmers, when you talk to just about any farmers, you look and say, "Well, gosh, corn's near $6 in the board," and they say, "But my inputs are way up too." So, right, so that even more the reason to be very, I guess, conscientious of, how and when the market needs to factor these variables in. And to be frank, the market isn't at some point. We've been through it thousands of times. It seems like before. It doesn't care what your inputs are, your cost of production. If it just feels that the market's going to use less, it goes down. Um, so it's incumbent upon the producer to not only be a really good producer, but also a good risk manager. Really kind of think these things through and scenario plan. So what should a farmer be doing? I'm still strongly of the mindset that the first 25 to 35% of expected production in any year based on, you know, high confidence levels of production, you should sell on value. A farmer should sell on value. What's value? Well, value is anything that probably 10, 15, 20% above the cost of production. At least what you think. I know everybody's going, well, how do I know what that is? Because I don't know what my yield is. Well, let's just assume a normal APH, normal yield. Let's try and pencil in some numbers and let's get started and really hope you're wrong because you're only doing 25 or 35%. If the market does move higher, reward it later and bring that average up. But so often in the winter months or early spring, the high prices turn out to be a pulley against low prices. They pull up the low price average. So a little wordy there, but keep at it is my point. Don't let last year's strategy for those who made money of doing nothing be your strategy this year. It might work, but it might be a huge risk at these levels.
Plenty of talk this week as well about ethanol, crude oil. I know we've had some testimony on Capitol Hill on the ethanol side. Crude oil, we've been watching, that moving up towards $95 a barrel, then pulling back. And really seems like crude oil has been very volatile along with the Russia Ukraine situation. How much are you watching oil, ethanol, and how this is all maybe playing into our ag markets? Do you think there's a story there to really watch as well with all this ethanol talk?
You know, I'm sure there is. Can't get my hands quite around it. So, ethanol, like any other business, it has margins, and margins ran a very high level and a good stretch for a while, and sort of tapered off here, and the grind has been high, so a little bit more inventory on hand. But I think the key to this whole idea, and one of the reasons why the money flows in energies is not only this geopolitical front, but just the idea that this COVID's on the run, down significantly, and that people are getting out and doing things, and you're seeing a lot of these, let's call it mandates or whatnot, going by the wayside fairly quickly. I know here in Wisconsin, I believe it was our chancellor said yesterday, the university system, off with the masks. We don't need them. I don't remember if you put a timetable on that, but things are returning quickly to normal or trying to. And so the pandemic is becoming more endemic where it's isolated, but as a whole, it looks like, for now at least, that's on the decline. That helps the demand market. That's part of the reason I think this cattle market has been up the way it has been. And so weight gain has been excellent, but yet cattle futures have been moving upward.
Well, let's segue to the cattle market talk there a little bit more. We've seen some decent cash trade this week, up, say about $2 higher in feedlot country. I mean, futures have been, we'll say, like you mentioned earlier, getting to new highs. We were down a little bit today, but overall, this cattle market, what are your thoughts there as we get close to wrapping up the week?
Well, to put it in perspective, we look at like the February contract. So at the end of January, trading around 135 on the low end, and all of a sudden 143. So we put on $8 in 2.5 weeks. Um, Pretty good surge. That tells us demand is good. Consumers bought into the Super Bowl weekend. They're getting out, they're moving around. Retailers might have been caught a little bit short. Same thing in the April contract, really good surge. Tried to correct back a couple of times. I liked on the 14th. And that day would really look like we're going to fall apart. You know, Pretty big slice under the 10-day moving average. And by the close, came right back and finished with a small gain. So tells me the buyers are still there. It's holding support. It's not a straight up market as in like some supply shock, but it's a nice grinding upward market with a little bit of surge here in February due to, I think, just expectations for growing demand. And and when you look at the big picture, I mean, there's some weather too. There's a storm system pushing through right now, and there was one earlier in the month. That's more in the central plains. Maybe they had a little more impact than I want to give it credit to, but in general, our guys are telling us that the weight gain's been good. The cattle are looking good. They're generally heavy this winter. It just hasn't been a harsh winter, and yet we've got contract highs established. That's indicative of something, and then you segue that right into the hogs, and they just continue to, have a day or two down and just come roaring back. New contract high scored again today on many of the contracts. So expectations for big movement, big demand worldwide.
That hog market, yeah, we got to continue to watch that. It just is soaring higher, as you mentioned. I know cutout values were up sharply again today, and be interesting to see where that hog market continues to go, and if it does find a top anytime soon. Brian, before we run out of time, dairy market. Any thoughts there? I know you mentioned that a little bit.
Yeah, a very volatile market as of late. So back higher today, 3 to, let's say, 24 higher as we talk right now. A lot of 22s on the board. We've seen some occasions of 23 or close to 23. Just terrific prices. I think the producer really um, wants to hedge this, wants to sell it at least up to 50% if you haven't. The temptation is, well, if we can hit 22 and a half, maybe we get 23 and a half, 24 and a half. These are really good prices. The dairy market doesn't have the history of accelerating upward and then staying up there for extended periods of time. So there's a couple of thoughts here. Look longer term, at least through the May contract, the next March, April, May. $22 or better, lock in 25 to 50% of that if you haven't already. Uh, the next months after that, I'd go 25%. They're all over 21 out to November, which is almost 21, December 2026. So those months are off a little bit from the front months. But think about the reality of what good prices they are and how historically the dairy market has been very volatile. I think you need to be selling into rallies. I'm not saying the producer's going to jump through hoops. Probably the biggest challenge for the industry, Jesse, is labor, getting enough labor. So that might be the supportive factor I'm not giving enough credit to, but we've heard that repeatedly.
A lot of things to consider. Brian, any other final thoughts for us here on this Thursday?
Again, in these kind of environments, don't kind of fall asleep at the switch. Um, we've had a nice steady upward trend, especially in new crop corn prices, November bean prices. Keep trickling some sales into there. Don't be afraid to sell into rallies. They have a tendency to really disappear quickly, and just be aware of that.
Well, Brian, if folks need a little advice, I know they can reach out to you and the Total Farm Marketing team very easily, either online, totalfarmmarketing.com, or by giving you guys a phone call, can't they?
They sure can. 800-334-9779. We always welcome a conversation. There's nothing better than just, kind of listening hard, hearing what people are concerned about or their needs. And that's what we do. So again, 800-334-9779.
Brian, appreciate the time as always, sir. Have a great rest of your week and weekend. We'll talk to you next week.
All right. Thank you.
Brian Doherty with Total Farm Marketing joining us today here on Market Talk. That's going to do it for the Thursday, February 17th edition of the show. Find us, markettalkag.com. I'm Jesse Allen. Have a great afternoon.